Welcome back. You're watching India Tonight with me, Sumita Karir, and my colleague Nivedna Prabhu. Let's move on then to our top story this evening. While concerns around trade and tariff, they continue to persist. U.S. Treasury Secretary Scott Bessent has said that if the United States court rules against Trump's tariff move, the government will have to issue refunds on about half the tariffs. Meanwhile, India's chief economic advisor, V. Anantha Nageshwaran, has said that if the penal tariff on India persists for longer, it will pose a much larger risk to India. Nivedna.
Absolutely, Sumita. And to decode that, we'll be joined by a stellar panel of guests. But let me take the opportunity to be introducing Mr. Dhananjay Sinha, who joins us on the broadcast this evening, who is Systematics Group CEO and co-head of Equities and head of research of the group. Mr. Sinha, thank you very much for taking the time out and joining us. Also on the show, beg your pardon, Dhananjay Sinha joining us. Mr. Sinha, apologize for that, but thank you very much for joining us on the show and taking the time out. Let's begin with the aspect of what we're looking at here, Mr. Sinha. Given the fact the CA has also highlighted that the GST cuts and low inflation act as tailwinds, potentially offsetting some tariff drag, do you see domestic policy measures like these sufficiently cushioning equity markets and corporate earnings?
So I think, see, the GST reduction is a significant move. I think it is on the back of the realization that there has been a persistent slackness as far as overall demand scenario is concerned, especially on the consumption side. And effectively, it's sort of high level of indirect tax incidence and reduction in subsidy has been a drag on the overall spending power and income scenario, and real income in particular. So essentially, what the government is sort of cognizant of is the fact that with the rising protectionism and rising tariff that would happen from that is happening because of high level of tariffs from the US at 50%. And the corresponding implication, the spillover effect that can be multidimensional. The government has sort of put in certain amount of this kind of stimulus by way of reduction in GST. Earlier, we had seen a reduction in the easing of the income tax slabs or income tax levels, and also the ELI scheme, employment linked scheme. All these things basically tells us that the government is cognizant about the headwinds as far as overall corporate performance is concerned. We know that the sales growth of non-finance companies in this particular quarter, the first quarter of this year, has come down to roughly about 4%. And that essentially implies that the growth scenario needs a certain amount of support, and the government is trying to do its bit. I would say in terms of the magnitude, the government says that the tax loss from the GST reduction would be about 48,000 crores, and which is, I think, it's a very modest amount given the context of the overall, household consumption, which is of the order of 200 lakh crores. So I would say that it's a beginning. It will have a certain impact on certain categories of consumption, but I think more needs to be done beyond what has been initiated.
Absolutely. Mr. Sinha, the Indian government has suggested in the past as well, in just the past few weeks, that there will be measures to boost domestic consumption and, of course, increase competitiveness. We'll have to wait and see what those measures are and how soon are those measures introduced, more importantly. In fact, ladies and gentlemen, on this broadcast, I'm now also joined by Vibhuti Jha. He's an ex-Republican candidate. Thank you very much, Mr. Jha, for taking the time out. Let me take you back to the statement that India's CEA has made. He said that tariff uncertainty may well move into the next year as well, and it does pose a major risk for India. Does it really suggest, that statement suggests that policymakers here in India have accepted for a no-deal scenario for a protracted period of time with the United States?
Not really. Actually, whenever these kind of a geopolitical turmoil happens, one has to prepare for the eventual or the uncertainty part of it. So I see here a golden opportunity for India to recalibrate its own policies and agenda. This is not a tragedy of a tsunami kind, but you can say there has been a flash flood, to draw that analogy. So I would put it this way, that India will have to quickly adjust to the impending threat that is in front. Trade negotiations will go on. See, because if you remember when Prime Minister Modi had come to the United States, I had said that the goal between India and the US ought to be how to expand the trade relationship from existing $100 billion to $250 billion. And I was delighted to hear both the president and the prime minister say that we will take it to $500 billion. But we are in at very difficult times, as they say in politics. 7 days is a long time. So the question here is, how does India recalibrate and reposition its own manufacturing, consumer, and the export of the products? So instead of now the traditional, what you call the traditional, don't keep all eggs in the same basket, you need to have a distributed arrangement. So which are the other markets that India can market its product or export the products? So I would say that while the trade negotiations will go on, and it will go on, I'm a 100% believer in that, is that something is happening behind the scenes. But what is also very critical to understand, as I heard the previous guest telling you, that the impact on Indian economy as a whole has been estimated, and I myself said that, to the tune of 0.2% to 0.5%. So GDP impact. So it is not grotesque, but it is serious. So it is all about adjustment. How do you fine-tune and adjust quickly to the whole scenario? And to that end, I think today's India is geared up to is geared up to handle that crisis, whether it's consumer area or production area, manufacturing area, export or import, whatever. So I think, in my personal belief, I think India is geared up to meet the challenge, because India will have to fine-tune its own policies. And that, I think, is a godsend to India, that there are times when you can't live in a world of ambivalence. You have to have a clear-cut policies driven by technology and the impending decision makings that happen from one government to another. And this is what is important to understand. Tariff in the United States, Mr. Trump is using as a political tool to create an advantageous scenario for America. Whether others are inconvenienced is none of his business. He's not looking at it from that point of view. So that how the tariff has been an economic instrument, has been used as a political tool to achieve certain goals. And to that end, I think the United States is putting itself in a bind, if I may say so, because the reason why they have done 50 penal, a secondary tariff on India of 25% and not on China, which is a global joke, as a matter of fact, is because the United States knows that China can squeeze America just by announcing suspension of all exports to America in the next 30 days. So the Chinese threat is big. India threat is virtually negligible in the American context. So that's why
but
you are
for the
seeing
moment,
this
I'd have to
India.
interject you there. But absolutely right. As far as repositioning for India also is concerned, we'll continue that. But let me also take the opportunity to be introducing our other guest, Anurag Singh, Managing Partner, Ansett Capital, joining us from Chicago. Anurag, thank you also very much for taking the time out. As a global investor managing capital from Chicago, Anurag, how are international funds evaluating India versus, let's say, other emerging markets? And from your vantage point, how are you looking at that, particularly in light of the persistent US tariff risks as well?
Nivedna, international investors have really moved on from this. So, as Mr. Jha was putting the point, that it's not a big deal for India, and it is not a big deal for US as well, right? So the point is, in terms of US investors, there are too many other avenues where there are things to worry about. What is the Federal Reserve stance? What will be the government regulation going forward? And all those are much bigger worries for now for the US economy. In any case, US economy is looking too strong. Growth last quarter was 3%. It continues to chug along very strongly. And I think US is pretty much looking for a very bright future locally. So investors generally have become now more bullish on US vis-a-vis last 6 months, at least first 6 months of the year, where the impression was that US might underperform the US market, the European or the emerging markets. Now the trend is back to US, right? And that's reflected even in the FI money exiting India on a continuous basis. Even for India, it's a choice India has made. So what was the choice that was given to India? There is a 45 billion of goods trade deficit. You buy something from US or open the market so that US can export more to India. India made that choice that no, we can't open up. We'll probably let loose of this 45 billion. The trade anyways will get balanced. Once the conscious choice has been made, I think as Mr. Jha was making all the points, pretty relevant points, that look, India now has to explore its own strengths and how it can move on from there. It's pretty much a domestic game. Indian economy, in any case, was not an open economy, right? Our remittances are 130 billion per year. Our FDI is 30, 40 billion per year. So, when FDI is 1/3 of the remittances, you understand
Right.
the economy is anyways pretty much closed.
Right. And we'll have to see the measures that the government comes up with. Anurag, you did mention about the GST rate rationalization exercise as well. You did mention about how the US markets are at the moment focused on Fed rate cuts, whether there's going to be a rate cut in September or not, and whether it'll be 25 bips, 50 bips. All of those factors will be watched out for by investors. And thanks very much for making that point. Let me come to you, Mr. Sinha, since we're talking about GST rate rationalization decision and the optimism surrounding it. But there is this concern that's looming large around FII movement, which are not showing meaningful interest in India. How do you expect FIIs to move over the next 6 months and, of course, in the near term?
So I think that the dependence on Indian markets on the FII flows has actually been reducing. And I would say that recently there has been an upgradation by S&P for India's rating. There has been a sort of upgradation from triple B minus to triple B. So that was expected to, that was sort of premised on the scenario that there is a macroeconomic stability, lower inflation, some control in fiscal deficit, etc. And that was expected to translate into higher FII participation into Indian market, both equity and debt. Whereas we have seen that it has continued to be on the redemption side. And I would say over the last 8 years, if you look at it, 3 years have been positive and 5 years have been negative or very modest. So my sense is that the inflow of FIs into India might actually continue to remain very patchy. And I would say in the context that people are looking at relative valuation, I would say it looks like other markets looks cheaper, and we are seeing China actually outperforming by significant margin. So if you look at Chinese indices, are actually gone up by 24%, whereas India Nifty or S&P BSE Sensex has been kind of flat. And so essentially, there is a considerable amount of dependence on local flows, both retail flows and the DIIs have been a significant participant out here. So I think that dependence might continue. We might see a lackluster participation by FIIs even going forward, because we think that the uncertainty from a global standpoint might continue, and the earnings growth might remain fairly modest. So I think from a valuation standpoint, growth standpoint, and the risk, global risk standpoint, we do expect that in the visible future, the FI flows might continue to remain lackluster. And we think that, recently we have seen rupee weakening as well. So it has depreciated to almost like 88, 83, 88, 30 or something. So there is a bias towards rupee weakening. And importantly, in the context where dollar is still weak, so that is a sort of variable that FIs might also consider while deciding on portfolio flows into India. So I think all in all, it is fundamental growth trajectory, relative valuation, and the uncertainty aspects that will be relevant from FI standpoint.
But Mr. Sinha, as you make that point, let me also ask you this: as an investor, how should one navigate this? Should they buy stocks now or wait?
So I think the trajectory that we are looking for is a period of, while these conflicts on tariff would remain. I think unlike in the past where US was significantly engaged with tariff wars with China, I think this time around India is quite in the center of the conflict, apart from the other parts of the world. So I think the uncertainty from that standpoint would continue to linger. I would say eventually there will be certain negotiations and there will be certain conclusions. I would say that relative to what we are today at 50% will be much lesser once things are settled. I think we'll be looking at something like 20 odd levels. 20% of tariff is what we are anticipating. But I think overall the fragmentation in world trade would continue even going forward, notwithstanding all the negotiations, etc., that we're looking at. Hence, we think that markets will be largely looking at what the government responses are, and the inflection that we have seen in recent times with higher focus of government policy towards addressing household income and livelihood issues, and the recent one being the GST rate reduction, will translate into significant focus on domestic plays. So I would say that Indian consumption stories might actually become much larger in the overall portfolio, and hence I would say in the backdrop that we've seen of last 7-8 years, where government were actually focusing a lot on infrastructure spending and supply side economics, the policies are going to be very different going forward. So I think it is largely going to be consumption led. I mean, recently people are very positive about the spillover effect on auto sector.
Domestic policy led. That's right.
So I think that is where people are looking at.
Right, and we'll have to see. Right. Right, Mr. Sinha, and we'll have to see whether through these policies will we see a comeback of FIIs back into the India market. But let me come to you, Anurag, and take that point that Mr. Sinha was making essentially about investments and how should investors be looking at the scenario now. What, in your opinion, should investors do, given that the turbulence hasn't ended and we don't know where it will end, even if the United States has negotiations with India? Mr. Sinha suggests that there could be a chance of having a 20% tariff. So where do you think the monies are going to move?
So, Sumita, I don't think India will get 20% tariffs at all, right? That's not the consensus view here, right? Ultimately, 25 surcharge might go away if India is willing to come to the table, but the base 25 would stay, because this is also apparently clear for everybody, even the government might not say it, that Indian government largely wants to keep the economy reasonably closed, right? The way it is. So US is not going to get a free run to Indian markets, which means it will have its cost, right? And it's not a big cost to India anyway. So that's a call India has taken. In terms of investors, I think these are the times where you just sit back and let the market do what it is doing. From 2020 to 2024, the returns were 20% CAGR on large cap Nifty and about 30% on mid and small cap. That was abnormal. Those returns do not come consistently for a decade or so, right? So everybody knows that. Eventually, the returns from Nifty 50 are 12% on a historic 30-year basis since 1994. Nifty 500, it is about 11%, so 1% less. And then half of this is inflation. By the way, Indian investors should also note that about 6.5 of this 12% is actually purely because of inflation. Now that the inflation is down, nominal growth of India is about 9%. Investors can expect 10% averaging. So regardless of what last 4 years have done, between 2021 and 2030, the growth is likely to be 10, which is not bad, right? Which is good. It is just that markets are never wrong. It's only your expectations that are wrong, right? So investors should settle down, focus on their work, and just let the markets do what they're doing. We can't advise investors to get in now and get out now. I mean, that's not that's not a prudent investing, right? Once they are in the journey, they have to last the good and bad times, right? So there will be times market will be abnormally spike up and give 20-30% returns. There'll be other times where it'll average out. So ultimately, as long as that's the expectation, 10 to 12%, India is doing strong, economy is strong, just that now it's a low inflation economy, which is good. So that's my broader message. But don't go all out on equity. Keep at least 20-25% into debt instruments as well, right? For the past few years, I know the environment was like, oh, there's nothing outside equity, but clearly now that's not the case.
All right, Anurag. So in the larger scheme of things, perhaps right the way. But Mr. Jha, what I want to understand from your vantage point is that the U.S. Treasury Secretary, Scott Bessent, has warned that refunding tariffs, if courts, of course, strike them down, would be terrible for the Treasury. One, how should India read into that statement? And two, is Trump prepared for the court setback, Mr. Jha?
That's a trillion-dollar question, no longer a million-dollar question. Mr. Trump will soon know whether his tariff play was a blunder, balderdash, or a brave move. I do not know that. But one thing is definitely true, that two courts, up to the appeal court, they have overturned, they have ruled, not overturned, they have ruled that the tariff is the jurisdiction of the US Congress, not of the presidential executive authority. And that's very critical. How the Supreme Court will view it, in view of the impending threat that if trillions of dollars have to be refunded, it's like a soccer game. You are down by 3 goals. Now you have to score 4 to win. That's the challenge that the American economy is facing. And it will have significant impact on the treasury drain. Where are you going to get the money? Your ability to print notes is already very significantly damaged. It will create a market panic. The buyers and sellers, they will be totally uncertain who will going to pay back, because the monies are not sitting in a bank or in treasury bills. They are actually spent already. And then there is a consumer and production squeeze that will happen because of that. So I have a feeling that Mr. Bessent is trying to educate the Supreme Court. For God's sake, don't go against ourselves at this moment. So you know this very well, that US judiciary system is rather peculiar and strange, because judges also have affiliation to either Democratic Party or Republican Party. And that's why the Supreme Court is overweighted with 6-3 majority in favor of the Republican mindset. How they will rule, one doesn't know. But if Chief Justice Roberts is an indicator, remember, he was the one who voted for Obamacare, despite being a staunch Republican, and he was a Bush nominee. The point of the matter here is that how will the tussle and the tug of war between the judiciary, legislature, and executive shape up in America? By the way, I must share with you and your viewers that a very venerable American once told me that democracy is not the most effective or efficient tool of economic governance. It's a political tool for checks and balances so that no one department of the government overwhelms the other one. And you are seeing the checks and balances play out in America in a remarkable way. So we don't know that, but on this, all the 3 elements, the treasury drain, the market panic, and consumer and the production squeeze, this will be a matter of concern. And I'm certain that Scott Bessent and President Trump are having sleepless nights on which way the big camel will turn. So that's what is very, very significant. And everybody now knows, like I said earlier on, the tariff has become a political tool. An economic instrument is being used as a political tool. How will it play out? We do not know. But the burden on US will be huge. It is not going to be easy. Would you allow me one little bit of a comment on Mr. Sinha's suggestion to, and your question about investors, how much they stay? Will you allow me that privilege?
Right. Please go ahead, Mr. Jha.
Yeah, I have been a private banker, so I was always a strategic advisor to high net worth individuals, and I always cautioned them: if your strategy is not changed, you change only your tactical adjustments. So investors must beware of one element. Market, as Mr. Sinha very correctly said, does what it is supposed to do, is to gyrate between one element to another, news, views, and rumors. So long as the investor knows that his priorities, his strategy has not changed, his needs and requirements have not changed, indulge very minimally on the tactical side, not on the strategic side, because you do not know which stock is going to go up, which debt instrument is going to go down. So, diversification is the name of the game. Thank you very much.
Right. Mr. Jha. In fact, that's essentially what Anurag and Mr. Sinha also suggested in terms of investments by investors into the Indian market. But let me ask you one more question since we're talking about Donald Trump. There's been a development over the weekend. Donald Trump has extended an olive branch via his statement on India-US ties, the fact that they are good, and the Prime Minister of India also appreciated his comments. What is Trump thinking, and is a deal then happening soon? What exactly is happening in the US administration on how it's approaching India and how it will approach India?
That's a very good question indeed. Thank you. The important part to remember is that I have always opined, I have always believed that India under Modi and the United States under Trump, they have significant convergence on needs and wants of each country. Absolute, I have always believed that. There would be occasional, divergences. So this was a divergence for a totally different reason altogether, the tariff thing. India was found to be, it's a matter of international joke that India was slapped with the additional tariff or, penal tariff because of Ukraine war. And some of the attack dogs, and I call them attack hyenas, not dogs, I'm a dog lover. So, attack hyenas of Trump administration went on a rampage, on remarkably immature statement, unwise statements, attacking India in every significant way. So much so that Indian Americans have become a target. So we have protested about that. So I would not take that statement very seriously. But of course, as the saying goes, a sign is a sign. Trump knows that he cannot do containment of China without India. He knows that. And India knows that if you want to deal with your permanent enemy called China, you need America too. So one of the things I always urge Indian Americans and India to not get into the verbal play, or India needs more, United States needs India more, and India doesn't need US anymore. Let's not get into those kind of semantics. What is important to understand, where is your convergence on principles and policies? And to that end, I always say that two large democracies are separated by democracy. So don't allow your fissures to become your policy prescriptions, then you are going to hurt yourselves. So I would take that as a positive, but I'm not going to sing and dance and open my champagne bottle, because it is what it is. Trump can change his mind tomorrow. And that's one of the reasons why Modi is not talking to Trump, because you do not know what Trump will end up telling the whole world. Modi was begging of me for peace and whatever. So there is a certain amount of thing. I will take it with a pinch of salt, but I'll welcome it.
All right, Mr. Jha. On that note, I want to thank you as well as Anurag and Mr. Sinha for joining us this evening. But for the moment, we leave the conversation at that. But we continue to track more important developments on India tonight. So let's put into focus